Welcome to Business with Louis, the show where we break down complex business concepts into actionable insights and inspiring stories. Today, we're exploring financial ratios explained, a fundamental tool that can help you unlock your business's full potential. Well, to start, let's define what financial ratios are in straightforward language. Financial ratios are numerical values that compare different aspects of a company's financial performance, such as profitability, efficiency, and liquidity. They're essential in the world of business because they provide a snapshot of a company's financial health, helping entrepreneurs and managers make informed decisions about investments, funding, and strategy. The concept of financial ratios has been around for decades, with roots in accounting and finance. One influential thinker, Benjamin Graham, known as the father of value investing, emphasized the importance of financial analysis in his book, Security Analysis. Over time, our understanding of financial ratios has evolved to include a wide range of metrics, from basic profitability ratios like gross margin and operating profit margin to more complex measures like return on equity and debt-to-equity ratio. Consider the case of Walmart, the retail giant. In 2020, Walmart's revenue was $524 billion, with a gross margin of 24.7%. This means that for every dollar sold, Walmart earned approximately $0.247 in gross profit. By analyzing this ratio, we can see that Walmart's business model is focused on high-volume sales with relatively low margins. In contrast, a company like Apple has much higher gross margins, around 38%, indicating a focus on premium products with higher prices. Another example is the debt-to-equity ratio, which measures a company's level of indebtedness. Consider the case of Tesla, which had a debt-to-equity ratio of 1.47 in 2020. This means that for every dollar of equity, Tesla had $1.47 in debt. By analyzing this ratio, we can see that Tesla is taking on significant debt to finance its growth plans, which may impact its financial stability and ability to weather economic downturns. So, how can you apply financial ratios in your own business or career? Here are some practical tips. First, start by tracking your company's key financial metrics, such as revenue, expenses, assets, and liabilities. Then, use online resources like financial calculators or spreadsheet templates to calculate relevant ratios, such as profitability, efficiency, and liquidity measures. Finally, analyze these ratios in the context of your business goals and industry benchmarks to identify areas for improvement. For instance, if you're a small business owner in the food service industry, you might track your restaurant's labor costs as a percentage of sales. By analyzing this ratio, you can identify opportunities to optimize staffing levels, reduce waste, and improve profitability. Similarly, if you're an e-commerce entrepreneur, you might track your website's conversion rate, average order value, and customer acquisition cost to optimize your marketing strategy and improve sales. In addition to using financial ratios, it's essential to consider other factors that can impact your business's performance, such as market trends, customer behavior, and regulatory changes. By combining financial ratio analysis with these external factors, you can gain a more comprehensive understanding of your business's strengths, weaknesses, opportunities, and threats. For example, let's say you're a fashion retailer facing intense competition from online giants like Amazon. By analyzing your company's financial ratios, such as gross margin and inventory turnover, you can identify areas to improve efficiency and reduce costs. At the same time, by monitoring market trends and customer behavior, you can adapt your business model to stay competitive, such as investing in e-commerce platforms or sustainability initiatives. In conclusion, financial ratios explained is a powerful tool that can help you navigate the complex world of finance and make informed decisions about your business. By understanding and applying these concepts, you'll be better equipped to drive growth, improve profitability, and achieve long-term success. Remember, financial ratios are like a GPS system for your business. They help you identify areas for improvement, optimize performance, and stay on track towards your goals. As Benjamin Graham once said, price is what you pay. Value is what you get. By using financial ratios to analyze your business's performance, you can gain a deeper understanding of its value and make informed decisions that drive long-term growth and success. Thanks for joining me on this journey into the world of financial ratios explained. If you have any questions or topics you'd like to discuss, please feel free to reach out. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.